Pardon me. I wonder if they can hear now because I just hit the live button. I don't know why we
Yeah, yeah. I don't think we're going live on YouTube.
ain't that something. And I was flowing too. Oh, I was flowing. 22 minutes. I apologize, everyone. I didn't hit the right button. Normally I have somebody that's doing my tech stuff. So we had Guy and I think a couple others. I appreciate you guys coming on. I really do, and I apologize for that. So we'll make sure to send you guys the stream afterwards. But just to kind of continue on, so I don't have to kind of redo the whole thing, and maybe I'll kind of rehash it next stream. Is the we work with probably 95% 1031 exchange investors. So meaning like they've made uh, the move of I'm gonna sell my property and move that capital over to a next property. They're a different type of buyer than the diversification where they're a little bit more sensitive to their capital, where the 1031 and has the intention of moving that money. So the market right now, there is lesser inventory currently under the 3 million price point, and then the clients that we are working on, we're doing multiple offers and trying to get the right one, trying to select the right opportunity. And some of them are, I would say, between 3 and 5 weeks between finding the opportunity to contract. So that's kind of a where we're at with some of those examples. And of course, values are going to change depending if we're in the Sun Belt, we're in Texas, Midwest, in different markets. Competitiveness can kind of go up and down there. We kind of covered this in my presentation of kind of talking about tenant credit, tenant bankruptcies. So quarterly, we put out an update on the tenant credit reports. So we're just kind of checking on what's going on with any changes there, with any investment grade tenants, because that's obviously very important if you're comparing these investments to treasury or other higher risk yield investments. Some people end up just saying, "Hey, I'm going to hold cash." So we're having these different types of conversations. So I want to just make sure that everyone has the data. We go through it clearly without emotion, and also look at it what net lease represents to the investor and the type of investor. Because obviously you can go buy rental property, single or multi-family or industrial, and get a significant higher return, or properties that have a value add component where you can be able to increase the rent, do renovations, and get a higher yield. But investors that buy into net lease, they kind of know exactly what they're getting into is a long-term lease with a contractual agreement with the tenant, and usually an essential needs industry, and they're planning on buy and hold for a little bit or for a long time, and they know that the rent's going to come in. There's going to be rent bumps, and that's just kind of where it is. This either could be from a diversification from your other active investments, or you could be saying, "Hey, I'm done being a landlord, and I'm getting into a totally different industry." So we kind of serve the investor in that their period of time in their career of investing, and what they want to do. So kind of keep in mind, because that goes into my previous frequently asked question of or my next segment of the educational piece of what should you be looking for and what should you be avoiding. And the thing is, avoiding is looking at deals that have this significantly high cap rates, because there's always caveats to it. So we'll go over that in a second when we get to that part. I think we're on our last FAQ. And again, if anyone can hear me, and I apologize again, just shoot any questions, or Quinn, do you have the call link, the Tidy Cow link? Just put that into the chat so anyone can, for any of your convenience that just want to set up a separate call. Because we said, like I said, we talked to probably 100 investors a day, and just kind of different, varying degrees of where they're looking at different deals they're looking at and different questions. So you may have something very unique that we didn't cover today that you want to kind of cover in detail on the call.
And Dwayne, after you make your point, if you don't mind, so I talked to an investor today. She asked if I can go over her situation to get your thoughts on it as well.
Okay, cool. So we'll do that after this last question, and then also the fourth segment. So next question was, where are cap rates trending for essential tenants, Dollar General, O'Reilly? So we kind of covered that in the beginning with the cap rates. So for Dollar General, for instance, which we sell a lot of those because it's a very highly essential need tenant. These places where you can get bread and milk and cheese, as well as very cheap everyday type of items, toilet tissue, but also you can buy small items that as compared to getting them to maybe your local grocer or some of your other local discretionary item stores. So those been ranging in the 5.75 to 6.25 cap rate. um, some of them a little bit below, but that's kind of the average range for 10 to 15 year term. Dollar Generals, for the most part, and I've been seeing a couple of the leases where they have some type of rent increase in the initial rent, the initial lease term, but for the most part, it's a flat rent for the first 11 years or the first 15 years. So if it's a $80,000 net income each year, that's it for 15 years. So if that's something that you're comfortable with, this will be a good fit. If you want something that has 10% bumps every 5 years, then we can look at other tenants. O'Reilly Auto Parts, we've been getting increase of I got a client that's looking to sell, and another client that's interested in possibly selling their O'Reillys. Those are ranging in the 5.5 to 6.1, 6.15 range. Those typically have 10% every 5 years. So those are kind of the average range. And then our quick service restaurants, Wendy's, KFC's, Pizza Hut, those type of tenants, those been in the 5.1s, the 5.75. And again, any of the details of any individual tenant, just let us know. We can pull up our data and we can send you a specialized report. And of course, like I said, this is all nuanced depending on the market. But in general, those are kind of the ballpark ranges that we're seeing nationwide. So today, and then like I said, we kind of sprinkled a little bit on a lot of the questions and some of the data that we touched on earlier. But for today, kind of a deep dive is what people get wrong. And I kind of mentioned that earlier, is that a lot of the calls we get in, people are very excited about the lease structure, a tenant paying all the bills, insurance, taxes, everything, which is like what we call mailbox money. But they want extremely, sometimes unrealistic high cap rate. And you have to understand is that you want your the tenant to pay you as much rent as possible, but you also want them to make sure that they fulfill their lease obligation as well. So we want to kind of keep it relative where the rent is within a reasonable range, from a rent to sales ratio, that they're making money and they're able to pay their rent, they're able to pay their employees and continue a successful business, and also have some type of buffer where if there's any instability in the market, that they can continue to last. So the last thing you want is to own a property and then kind of be sweating bullets to think that any ripple in the market may affect the tenant's ability to pay rent, which is ultimately the end game is for them to pay rent. So we always look at it from a within our data we cover certain all of the markets that we cover, the cap rates is the rent to square foot as well as price per square foot, and see if it's within range, and just making sure that your tenant's comfortable, because at the end of the day you want to make sure that both sides are happy to a degree. Obviously we want to get you the highest return as possible, but at the same time it has to be relative to make sense. And that goes back to the type of profile of investor or the type of investment in your career of, okay, I have other investments, or I'm doing a 1031 exchange and here's kind of the going rates, and I'm kind of comfortable with that, and then we can kind of work with you to be able to find something that makes sense, where it's a kind of a happy medium. Another thing some investors get wrong is kind of ignoring the tenant financial health. So that coincides with the high cap rate. So obviously, a high cap rate seems very attractive, but at the same time, the negative is that that could be maybe a lower tier tenant that has to pay a higher rent per square foot to make up for it. And when you're dealing with investment grade or very highly popular tenants, off the top of my head, McDonald's or Chick-fil-A, when you see our reports, they're trending in the 3s and 4% cap rates. These stores do very well. So we want to make sure that we're kind of seeing what you want and making sure that it makes sense. So, and of course, we look at the lease itself. When we help clients, we go through or reading through the lease. We're checking all of this stuff to try to make it as hands off and a very comfortable experience as possible. So that's very important. And of course, linking yourself up with a very good attorney that's very familiar with leases and due diligence to make sure that you have everyone on your team that is able to put this thing across the finish line. And of course, like I said, us as the buyer side representing the buyers, we want to make sure that we're getting the best location. We're looking, like I said, the tenant's ability to pay rent, their financials, the lease term. Obviously, most investors are looking at 8, 10 plus years on the lease. And then again, what's your game plan? Some investors, they want to buy with a 1031, but they want to sell in maybe 5 years, or they want to hold it long term. So once we kind of know a lot of that information up front, the better we're able to kind of serve you and provide a lot of different options. And then we can kind of run it through and see what makes sense. And then ultimately that'll allow us to kind of take an action from there. So before I get to the final segment, we're just kind of talk about what we're going to be doing in the future with our live streams, as well as kind of what to look for in the emails. Quinn, what was that question you had mentioned from that investor?
Yeah, so she had did a 1031 exchange prior, and she owns her properties free and clear. And given where the interest rates are, she wants to buy another property, but she wants to take out leverage against it or refinance. So she wanted to know what would be the best strategy given she purchased the AutoZone cap rates. Some of them are trading between 4, 4.25, 4.5. She said she would be losing money if she did invest, or given where the interest rates are, if she did refinance, what would be the best type of property for her to look at?
So repeat that first part again. I didn't catch that first part.
So she did a 1031 exchange a couple years ago, and she owns her properties free and clear. She paid all cash for it. So she basically wants to refinance and buy another property. But given the interest rates where they are right now, she's just having a tough time trying to swallow that, given where the rates are. So she wants to know what would be the best situation for her.
Yeah, I mean, it just that question would be more of a mortgage lender to kind of find out. Obviously, the rates are changing all the time, and then depending, of course, the property and the location of it, and then see how much she can possibly pull out, and just kind of being realistic with the numbers. In some cases, that we may not be able to make something work. So we just got to look at all the options. So I just kind of say you normally kick this over to our mortgage lender and then see how much potential equity we're planning on playing with, and then look at the what's available on the market and see what we can match with. I have some other investors that they pull cash out of free and clear properties and invest into syndications. Syndication is just fractional ownership of properties, and that could be in large scale properties like Walgreens or Fresenius dialysis, or they just diversified and get into other industry sectors like multifamily or medical office and things like that. So I think just we'll send over the referral to Dave Simmer, or I think our other mortgage lender we refer out to, and just kind of see what numbers we're playing with. And then we'll see what available on the inventory, and then kind of see what the game plan is. Usually we just get a conference call together and say, where we're at, what we have to play with, and then here's kind of the realities of the market, and just kind of see if we can mesh something together. So I think that's the best move. So if you can set up a call with us, we can just jump on a call and see how much available equity and see where we can kind of mix and match what makes sense for you. So I think Tiffany. Oh, hey Tiffany. How often are you seeing investors purchase through a syndication model? What are the cash on cash returns or the operators usually seeking? So we do have a couple syndicators that I've talked to in the past. Is I was heavily into raising capital for multifamily. I still currently do, but most of the stuff is into mixed use, industrial, and medical office. Um, that definitely doesn't, and they come from like the multifamily world because they're trying to find some kind of diversification. But the cash on cash returns is, again, is nothing what you're seeing on the multifamily side. So this is completely just for capital preservation and just like legacy play. So if a lot of the times when they end the syndication of a value add multifamily, they'll be in there for 5 to 7 years. They'll implement the business plan, and then they do their exit, and then and they're looking to do the payout to the investors. They allow the investors to do an option with 1031. So a lot of times, they may not make sense to go into a new deal, especially now where we're looking at higher interest rates for mortgages to get into multifamily, and of course the increased competition to get into these deals. So they're just looking at just kind of getting that money into something, so they can kind of protect the capital and keep some type of continuous cash flow. So I've seen some guys where they end up saying, "Hey, I'm going to just put my money into a DST or some type of tick for a net lease," and they're still ranging from what we kind of covered in the report before, is that 4 to 6% cash on cash range. But if you add on that, obviously you're chunking into that. If you're going in maybe 50% LTV on it, it's not a huge amount of spread. So it really comes down to if your investors just are comfortable with the game plan of, we want to kind of preserve our capital into a very either investment grade or very strong, corporate tenant. So obviously the numbers can vary because you have built-in rental increases, but you're not going to be seeing numbers that you will see like 7-8% cash on cash return like multifamily properties are promising. So I know that we had kind of talked a little bit about that before, but yeah, it's just that's just kind of the reality of this type of investment is just very conservative returns. So, and most of the investors that we deal with, they come from the multifamily side. They made a lot of money, or they have a business, or they have a lot of cash, and they don't want to put the cash into a CD, and they don't want to put it into treasuries because it's lower yield as well. So they end up going to net lease. So, but as far as syndicating it, yeah, there's definitely opportunities, because then we have to find kind of the investors that are okay with a conservative return, don't have really a time frame to have their money back, because you're not going to get a huge equity multiple on it, and just kind of looking for a longer term play. So once we just keep crunching the numbers, there's obviously some industries that are more aggressive on the yield. So I was probably look into those to see what we can put together. But for the most part, if your investors are okay with kind of that set range of return, it's still definitely worth it. So I hope that answered your question. If there's any follow up after that, but it's yeah, it's that's one of the things, like I kind of going back to the last point of they want, everyone calls and they say I want an eight cap or 7 cap, and I said, yeah, we can find it. It's just going to be a very high risk location, high risk tenant, and like for the most part, the mindset of the net lease investor is conservative returns, long stable cash flow with a corporate or investment grade tenant, and they're just like they're happy with long term lease agreement with a reliable tenant. With multifamily, it's risk, because you have to involve you know very aggressive management, then you have construction, and then you have markets where you have to turn over properties and release them and deal with different things like that. So the return gives you that, because you're putting a more higher risk. Here 15-year Lease and a Chipotle, and it goes up 10% every 5 years. And some people visit the store and they're like, it's nothing, it's not sexy. Go there and like, can I get a burrito? And then you leave. Like they paying the taxes, they paying the insurance, they paying everything. It's just like, we have clients that they never visited their location. They just buy it sight on scene. They may go like maybe the due diligence period, but it's a very boring investment. So which is cool, that's what we like about it. Um, so yeah, like I said, it depends on your strategy and what your investor strategy, and we can kind of see what the highest yield out of the sectors. But for the most part, that's where we're kind of expecting. So, but I appreciate it. Thank you, Tiffany, and thank you again for joining. This has been great. So with our one or two subscribers or people that are joined on right now. So I'm hoping everyone is hearing the audio now. I know we kind of started out a little bit shaky with that. And I thought this StreamYard was going to solve all my problems and make it a lot easier, but I apparently didn't click on the button. So I appreciate everybody's patience on that. So we're at 2:45. So we had kind of planned to do half hour to 45 minutes for the first one. And again, we're going to be going on here every week at 2. And I'm going to bring on, guests. So I have talked to Dave Semmer. And who's the other guy, the mortgage lender guy? I think he's from M&M.
Stephen Filippo.
Yeah, Stephen Filippo. And just to kind of give fresh perspective, where we're at in the market, what they're seeing as interest rate. And what I normally do with Dave is we just like run scenarios. So we'll get like either a deal under agreement, or we're looking at like 2 deals and we're like kind of in that beginning stage, and we'll just start crunching numbers and we'll say, okay, you're looking at this on the average mortgage payment or interest payment, and we'll just start crunching numbers and say, okay, here's our target. So now we have kind of like a game plan in place. So that'll be great to come have him on. We usually refer out to about a handful of attorneys. So we're going to try to rotate them to see if they want to jump on for 10, 15 minutes. If you have any questions on any active deals or any just, general attorney advice on the process, we're going to go over, of course, specifics on the process from acquisition to close, and, the whole, step by step, what are we going to cover, what to look out for. And of course, we can get a little bit of nuance and a little bit of extra details from an attorney's perspective. I have a cost segregation specialist named Sabrina Gettler over at CSSI, and she does a great service where, and if people are not familiar with a cost segregation report or service, where you're able to depreciate intricate items of the property itself. So it's a very good option for, syndicators or people that just want to, maximize as much tax benefits as possible. So a combination of 1031, doing a cost seg report, and we'll just see if it makes sense. Some deals it doesn't make sense, and some deals it makes sense. So just kind of give her perspective, fees, the process, and just kind of, giving her take on that. I've talked to a couple intermediaries over the years, and I know there's so many of them. So because it's very important when you're planning on selling that, of course, once you do the sale and you're at close of escrow, that you can't touch the funds. That has to go to a third party intermediary in order to qualify for the 1031 exchange. So just kind of giving general details and a pitch at the end of the benefits of, what to look out for a good intermediary, bond insurance and credibility and all that type of stuff. And just to kind of get you to plan out and process. Cause I know many investors that we talk to, they're calling us like 4 months before their close of escrow, because they're like, want to make sure that everything goes smooth. And you definitely need to do that, because by the time you blink, you're in your 45-day period, and you don't want to be, like on a Sunday afternoon scrambling and seeing if you can get a deal done. And then, or we get something under contract and we're in due diligence, we find out something crazy was going on with the property and we have to get out of it, and then you didn't have no backups. So it's very tricky, and so we got to make sure that we kind of plan ahead as much as possible. And of course, we're going to monitor it. I say about 95% of our investors we work with are in exchanges, so we're kind of used to this fast-paced type of world. And yeah, those are the kind of the most of the players that you're going to need on your team. And of course, like I said, any other resources, over the years that we've had, a lot of documented reports and procedures that we can send over to just to make sure that that whole process is smooth. So again, I appreciate everyone that's joining on. And again, I apologize for the audio. I'm going to send this out in the email, but I'll make sure that we're going to be on track next week with some fresh data. Look out for next Monday's report. And also other stuff. We're going to be planning on doing some Wednesday webinars that we're going to be going through other topics like these FAQs, but going to really deeper, intricate detail. Just to kind of give out more value, just to make sure everyone has everything they need to be prepared and just feel more comfortable, especially as we're seeing a lot of movements in the market, a lot of fear and uncertainty, and kind of baiting for people in the media. So I want to make sure that you have the data, we all analyze it together, and then we know how to interpret, and then also connect it with your goal and see if it makes sense. So when we finally make a decision, okay, we're going to do this, you feel very comfortable, and it's like, all right, cool, we're ready to go. So that's what mostly I had. If everyone would like, because I detailed a lot of this, it took a lot of time to put together my latest book called the Net Lease Playbook. We go from kind of identifying where you're at in your career of investing, your goals, and walks through all of the steps from acquisition all the way to close, advanced strategies like 1031 cost sags, bonus depreciation. I review all of the tenant sectors, pros and cons for each, what to look for, lease structures, what to look for in the leases. I also give video explanations of all of the different type of stuff. So I just try to put as much as possible from the over a decade of experience dealing with investors like yourself, and just kind of making sure we store everything out there just to make your job easier, because I know it's stressful. I'll say majority of the investors we work with all have families, married, have kids, they have day-to-day lives. So we're here kind of as your team to kind of facilitate the process and make it as simple as possible. So I appreciate it again. Thank you all. Thanks, Quinn, for joining. Look out for his calls. You're going to be harassing your phone anytime soon, and hopefully you pick up and have a nice conversation. And whenever you're in town, come grab some lunch with us. So we appreciate it, everyone. Everyone have a great rest of the afternoon, and peace out.